The market price of a stock is usually much more volatile than the intrinsic value or the actual true value of a stock. Like over the long term, while the market price may go up and down, over the long term, it usually ends up around the same as the true value of a stock. Which is why if you um, are trying to decide if you should buy a stock or if you are trying to decide a stock's value, um, you should calculate the intrinsic value first. So with the discount cash flow method, it uses the value of an investment. So what is the value of an investment? The value of an investment is the present value of all of the expected future free cash flow generated from this investment. The free cash flow is basically the money a company has left after paying for its expenses. And the present value is basically the value of money right now, presently, after you account for factors such as inflation, risk, and potential returns from risk-free investments. Like as I said before, $1 you receive today is greater or more than $1 received after 1 year. Besides inflation, there's also like the potential return from investment. For example, if you have $1 today, you could invest in it and earn more money than if you had $1 after 1 year. So you can calculate the present value of your money using this formula, where F is the money received or the money you think you will receive in the future, and divided by 1 plus R. And R is the discount rate from the future to the present time. The discount rate is kind of like the deterioration of money, a little bit like that. It's basically like the deterioration and like the rate your money is affected from factors like inflation, risk, etc. So here's an example. An investment generates a constant free cash flow of $100 each year. So assume the annual discount rate is 10%. What is the present value of its free cash flow in each year? And what's the value of this investment? So you can use this formula to find the present value of the free cash flow in each year. Where you have the $100 or the free cash flow you got divided by 1 plus the discount rate. Here it's 10%. And in year 2, then it's about the same formula. Your free cash flow or the money you have, 100 divided by 1 plus the discount rate, 10%. Except since the discount rate adds up or is the discount rate adds up over time, you take the power of 2. So then you have this formula. Mm, in year T, the present value of free cash flow is then 100, your free cash flow, divided by 1 plus 10%, or the discount rate, to the power of t, because the discount rate is compounded over time. Then if you add all of this up, the value of the investment is the present value, sometimes shortened to PV, of the free cash flow in year 1, in year 2, in year 3, and on and on. So here then are the main steps to value a stock by calculating its intrinsic value per share. You have the total First, you have the total present value of a company, or the enterprise value, sometimes shortened to EV. The enterprise value is then the PV, or the present value of the free cash flow in year 1, the present value of the free cash flow in year 2, and year 3, in year 4, in year 5, and so on. Or with this formula. After this, after you calculate the enterprise value, which is what I will talk about in today, you adjust for non-operating assets or liabilities. Basically, you calculate the equity value, which is the enterprise value plus the cash or cash equivalents minus the total debt. This is because many companies, if they have extra cash, they put it in a bank account or they invest it. So you have to account for that too. Plus, a lot of companies have debt, so you subtract the debt from the total value. You can mostly find all of these on a company's financial report. Anyways, then you have the equity value, which is basically like the true value of a company. Using this, you can calculate the intrinsic value per share, which is basically the equity value or the value of the total company divided by the number of shares it has to find the value per share. So I'll give you guys a moment to look at this. Does anyone have any questions they want to ask so far? Okay. So now let's calculate the enterprise value. Mm, Last time I also talked a little about this, but we didn't fully calculate the enterprise value. So the enterprise value from this formula is like this. However, this formula isn't really complete, like it has some problems. So the first problem or difficulty is the discount rate in each year. So we assume the discount rate is the same for each year. However, since the discount rate is compounded over the years, we have to account for that. Typically, we use the company's weighted average cost of capital, or WACC, as the annual discount rate. Here we will denote this by R. So then the enterprise value is instead of this, we like add exponents to this. So in year 2, the discount rate is basically, or the total rate is 1 plus r to the power of 2. In year 3, it's 1 plus r to the power of 3. In year 4, it's 1 plus r to the power of 4, etc. So now we have this formula. Our second difficulty is estimating the free cash flow of a company, or like of the free cash flow. So we have two methods of estimating the free cash flow. One is assuming the free cash flow margin is the same in each year. We can first estimate the revenue in that year or in year T, and then estimate the free cash flow in that year. Because the free cash flow is the revenue times the free cash flow margin. Or a similar equation is the free cash flow margin is the free cash flow divided by total revenue. The method 2 for this is assuming that the free cash flow growth rate is the same every year. So you first calculate the free cash flow in the current year and then estimate the free cash flow annual growth rate. And then for example, if you wanted to calculate the free cash flow in year 1, you would find the free cash flow or the starting free cash flow times 1 plus the annual growth rate, or the estimated growth rate for the free cash flow. And then in year 2, that will just be the previous year times the growth rate, or since the free cash flow of year 1 is the free cash flow of year 0 times the growth rate, you would have for year 2, the starting free cash flow for year 0 times 1 plus the annual growth rate of the free cash flow to the power of 2. And for year 3, that would be the starting free cash flow times 1 plus the growth rate to the power of 3. Because, of course, the growth rate is also compounded over time. So, does anyone have any questions about this? Okay, so now you get this formula where M is the free cash flow margin and C is the revenue in that year, divided by 1 plus R to the power of whatever that year is. For example, if you had year T, that would be the free cash flow margin times the revenue in year T divided by 1 plus R to the power of T. So the next question is, how do you estimate the revenue in year T? We assume the company's revenue has an annual growth rate, G. So, speaking of which, for estimating the free cash flow, we usually use method number 1 because estimating the free cash flow margin is easier than estimating the free cash flow growth rate because the margin is usually more stable. It's really hard to estimate the growth rate of the free cash flow for a company because growth rates can like go up and down really quick. And so we have that formula. Okay, then the next question is, how do you estimate the revenue in a certain year? We assume the company's revenue has an annual growth rate G. So the revenue at year 1 is the starting revenue times 1 plus G, or the growth rate. The revenue at year 2 is the starting revenue times 1 plus G squared. The revenue at year 3 is the starting revenue times 1 plus G to the power of 3. Okay, so finally we have this big formula where the enterprise value is for each year and M, where M is the free cash flow margin, times C, where C is the revenue, times 1 plus, or the starting revenue, times 1 plus G, where G is the growth rate, or the estimated growth rate of the revenue to the power of T. And again, T is the year that it is in. That is then divided by 1 plus R, where R is the discount rate. And then again to the power of T. So now, are we done with this formula? Okay, this is a question actually. Does anyone know if we are done with this formula or not? Okay. If you guys are saying something, I can't really hear you. Okay, fine. Well, the answer is we aren't. Of course, if we were, I wouldn't be asking this question, but whatever. If we calculate the formula like this, the enterprise value will go on into infinity because then you would have, because right now you would have like an infinite amount of years. However, most companies mature after a period of time and don't grow as fast or don't grow at all, and some companies go bankrupt or something. So we need to account for this. And this is where we stopped last time, right? So today I'm going to introduce, for the formula, I'm going to introduce a second step or a second stage. For this formula, we will assume a company has 2 stages. A steady growth stage, which is the one we calculated previously, and a mature stage. Usually the steady growth stage typically lasts for 5 years with a fast growth rate, sometimes up to 10. So right now we're say the growth. So on average, the growth rate is like 10%. Then the company enters the mature stage, which lasts for many years, with a low growth rate, like 2%. So if we fit that in, then after 5 years, the growth rate will become G0, which is the mature growth rate, or 2%. And this becomes the steady growth stage, and this becomes the mature stage, where the company doesn't earn as much, but doesn't really earn anything. So right now we have two stages, right? One where the growth rate is really high, one where the growth rate basically stops, like the company becomes a mature company, where like it has like still like steady earnings, right, mostly, but like it doesn't grow as much. So now let S equals the mature stage. So then if you multiply both sides by 1 plus G0 divide by 1 plus R, you have this, where since you multiply both sides by 1 plus G0, or the mature growth rate divided by 1 plus R, you have this. And you can see the exponents like are like grow higher. Now, if you subtract these two, now if you take those two equations and subtract them, pretend this bottom one is at the top. These cancel out, right? So this whole bunch cancels out, and you have 1 minus 1 plus G0 divided by 1 plus R times S, because there's a 1 in front of this. And then since all of this is canceled out, you have this chunk remaining. Basically, if you find S, then that is equal to M times, where M is the free cash flow margin, times C0, where C0 is the starting revenue, times 1 plus the mature growth rate to the power of 6 divided by R minus, where R is the discount rate, minus the mature growth rate G0, times 1 plus R to the power of 5. Which again, this is much more comprehensive. Like, this is much more calculable than this giant chunk of thing that goes on into infinity. So you can calculate it like this. So then the enterprise value becomes the steady growth stage plus the mature stage, which we calculated as this here. Where again, TV is this. And before I continue, do you guys have any questions or comments? I'll let you guys look this over. Right. So finally, we basically calculated the total present value of the company, or the enterprise value. Sometimes on like stock websites you can sometimes, or if you search it up, sometimes you can find the enterprise value, but today I'm just gonna go into how to calculate this. So using this formula, you can calculate the enterprise value, and using the enterprise value, you can find the true value per share, which is the enterprise value plus the cash divided by cash or cash equivalents minus total debt, and totally divided by the number of shares outstanding. And you have the intrinsic value of a company. So in conclusion, the valuation using the discounted cash flow method is influenced by several key factors, including the discount rate, growth rates, forecast period, terminal value, free cash flow, or free cash flow margin. So, to, right now we like set our discount rates, growth rates, etc. But the val the value using the discounted cash flow method can sometimes change. Like maybe you disagree with the um, discount rate or the growth rates. And basically, the value you calculated depends on a lot about some variables and key factors you chose. I can go over this. The discount rate is often the weighted average cost of capital, WACC. You can find this if you search it up online. This reflects the opportunity cost of capital and the risk profile of the investment. The growth rates, um, assumptions regarding the growth rates during both the steady growth stage and the mature stage can significantly impact the valuation. So selecting the growth rate is really important and should be carefully estimated based on historical performance, industry trends, and future expectations. Because calculating the enterprise value sometimes depends really heavily on like growth rates and discount rates, as you can see from our formula. The formula we end right now the formula we ended up with is um assuming also that like is assuming also the forecast period where this time we set at 5, which is the steady growth stage, typically 5 to 7 years on average, and the terminal value, which is the which is the thing we calculated here. This accounts for the value of the cash flows beyond the forecast period. So this is the time when the company slows its growth. And then there's the free cash flow margin, which you can also estimate. This also plays a crucial role in determining the projected cash flows, and this margin should be realistic and based on the company's operational efficiency and industry benchmarks. So right now, you can use this thing which we calculated. You can use the enterprise value, which formula we calculated today, and you can use it to find the value of stock. And again, once you find the value of a stock, you can compare it to other stocks in its sector or similar companies to find the value of a company. And I also had a spreadsheet for calculating like the possible growth of a stock. But yeah, that hold on, what okay, that is basically the end of my lecture today on discounted cash flow method. Does anyone have any questions? Okay, did anyone like does does anyone like know like how we calculated this formula, how this formula works? Okay. Well, overall, this concludes um this lecture on the discounted cash flow method. I think besides it's almost